Did you know that one single deposit, just one check from an inheritance, insurance claim, or legal settlement, can completely wipe out your SSI benefits? Every month, hundreds of recipients lose their checks because they never realized how one-time money is treated by the Social Security Administration. And here's what's scarier. SSA is now using an AI-powered system under Emergency Message EM25046 to track your bank accounts and spot lump sum deposits automatically. That's why you need to stay with me through this entire video. I'm going to show you how inheritances and settlements are counted, how the spend down rules work, and how to protect your SSI before it's too late. Now, if you're new here, welcome to Social Security Post, your trusted channel for explaining every rule the SSA doesn't always make clear. Make sure you hit that like and subscribe button so you don't miss our next update on EM25046 and SSA's new digital payment monitoring system. And if you have any questions about inheritances or lump sums affecting your SSI, drop them in the comments below. I personally read and reply to help you understand your situation. By the end of this video, you will know exactly what counts as income, how to spend down a large deposit the right way, and why SSA's new bank crawlers are making it almost impossible to hide a windfall. So stay tuned. You can't afford to miss what I'm about to explain. Let's start with the basics. What does SSA actually count as income? SSI is a need-based program for people with limited income and resources. The limit is $2,000 for an individual and $3,000 for a couple. If you go over that limit for even a single day, you can lose your SSI until you get back under it. SSI divides income into two main types: earned income, like wages or self-employment, and unearned income, like gifts, inheritances, lottery winnings, or insurance settlements. Here's what most people miss. Even if the money comes from a relative, a lawsuit, or life insurance, SSA still sees it as unearned income in the month you receive it. So if your aunt leaves you $5,000 in October, SSA counts that $5,000 as income for that month. And if you don't spend it down quickly, it becomes a resource in November, potentially ending your eligibility. Even a one-time deposit from an insurance claim after a car accident counts the same way. The key thing to remember is this: SSI is not like SSDI or retirement benefits. It's based on need. That means SSA constantly checks your bank balance to make sure you don't have too much money. Understanding what counts as income is the first step to protecting yourself when you receive unexpected money. Now here's where a lot of people make mistakes. When you receive a large deposit, you actually have a small window to fix it, what SSA calls the spend down period. If you receive a lump sum in October, you have until the end of November to bring your countable resources back below $2,000. If you don't, SSA will stop your SSI starting December. That's because resources are measured on the first day of each month, and if you have too much that day, you're ineligible for that entire month. So what counts as a legal spend down? You can use the money for basic needs: rent, medical bills, utilities, debt payments, vehicle repairs, or home improvements. You can even prepay for burial expenses or replace furniture and appliances. What you cannot do is gift the money to someone else or move it to another person's account to hide it. SSA will see that as a transfer of resources and penalize you. Here's a real-life example. Sarah from Texas received a $6,000 inheritance on October 15th. She used $3,000 to pay medical debt and $2,000 on car repairs by November 25th. By the 1st of December, she was under the $2,000 limit, and her SSI continued without interruption. Another recipient in Florida waited too long and lost 2 months of payments. The lesson: act fast, plan your spend down, and keep every receipt as proof. Now this is where the game really changed. In 2025, SSA implemented Emergency Message EM25046 EM25046, expanding its access to Financial Institutions Program, or AFEA. Under this policy, SSA no longer relies on recipients to self-report large deposits. Instead, they get direct data feeds from banks, credit unions, and financial institutions across the country. If you receive a $10,000 deposit, the system flags it automatically. It's not about trust anymore, it's about digital proof. SSA created this system after years of overpayments caused by undetected resources. The Inspector General estimated that more than $1 billion in overpayments came from unreported bank balances. Now, EM25046 gives SSA a way to cross-verify your financial records electronically with partner banks using automated crawlers. It runs periodic searches on balances, deposit patterns, and linked accounts to spot suspicious activity. What does that mean for you? If you get a check from a lawsuit, insurance company, or family estate and don't report it, SSA will likely see it anyway within weeks. Once that happens, they can suspend your SSI and demand repayment for each month you were over the limit. So the best defense is reporting immediately before the system flags it for you. If you ignore a lump sum and hope it slips through, you're setting yourself up for serious trouble. Once SSA discovers an unreported deposit, they will treat each month you were over the limit as an overpayment. That means you'll have to repay all the SSI you received during those months, sometimes thousands of dollars. If you can't repay, SSA may withhold future benefits until it's recovered. It doesn't stop there. In most states, SSI eligibility is linked to Medicaid. If SSA suspends your SSI, your Medicaid could end too, leaving you without health coverage. And if you're found to have intentionally withheld information, it can even be considered fraud. The Office of Inspector General investigates cases where recipients try to hide assets or transfer money to others to avoid reporting. A real example: one recipient in Georgia received a $9,000 insurance check after a storm. She thought since it was for repairs, she didn't have to report it. 4 months later, SSA flagged her account through EM25046 and sent a repayment notice for over $3,000 plus interest. It wasn't intentional fraud, just a misunderstanding, but it cost her months of stress and appeals. When you receive a large deposit from any source, you should report it to SSA immediately, not weeks later. The rule is clear. Report any change in income or resources within 10 days after the month it occurs. That means if you got an inheritance on October 10th, you should notify SSA by November 10th at the latest. Reporting can be done by phone, mail, or in person at your local office, but always keep a written record or confirmation. When you report, provide documents like the settlement letter, inheritance statement, or bank deposit record. SSA may ask how you plan to use the money and help you understand if a spend down will solve the issue. Sometimes they can delay a suspension if you show that you're spending the funds on necessary items before the deadline. Transparency is your best friend here. If you have a representative payee or lawyer handling your case, make sure they also report the change. SSA holds the recipient responsible even if a rep fails to notify them. So double-check everything. It's better to over-report than under-report. That's how you protect your benefits and avoid any surprises from those bank crawlers watching behind the scenes. If you know a settlement or inheritance is coming, plan ahead. One of the most powerful tools is a special needs trust, SNT, a legal arrangement that holds money for a disabled person without counting as their resource for SSI or Medicaid. Funds in the trust must be used for the beneficiary's needs, like housing, transportation, medical care, or education, but it keeps SSI intact. Another option is an ABLE account, which allows you to save up to $18,000 a year, $2,025 limit, without affecting SSI. If you work, You can sometimes contribute more from earned income. The money must be used for disability-related expenses, but it's a great way to hold small inheritances or insurance payouts safely. The worst thing you can do is wait until after the money arrives. If you know a settlement is coming, talk to an attorney who handles SSI or disability planning right away. Setting up a trust or ABLE account before the check is issued can save your benefits. Once the money hits your personal account, SSA counts it as a resource, and no legal document can erase that after the fact. Technology has made SSA faster and smarter. By 2025, the Access to Financial Institutions system was connected to more than 3,000 banks and credit unions nationwide. That means almost every financial institution you can think of, Wells Fargo, Chase, Bank of America, and even many local credit unions, now share account data with SSA under federal agreements. This used to be a manual process. Now it's fully automated. The reason so many people get caught is because they still believe SSA relies on paper statements. That 1980s rulebook is gone. EM25046 authorized near real-time cross-checking of balances. If your account suddenly goes from $200 to $8,000, the algorithm flags it instantly. You might not even get a call before a notice arrives saying your SSI is suspended pending review. Every year, SSA finds more unreported deposits and issues overpayment notices worth hundreds of millions of dollars. The goal is to protect program integrity. But for honest recipients, it can feel like punishment. That's why being proactive and transparent is the only safe route now. You can't outsmart the crawler. You can only stay ahead of it. Let's bust some myths. Myth number 1, if the money came from family, it doesn't count. That's false. SSA doesn't care where the money came from, only that it's available to you. A gift from your brother, a check from your mother's will, all count as unearned income. Myth number 2, if I spend it fast, I don't need to report it. False again. Even if you spend it the same week, SSA still considers it income that month. You must report it regardless. If they later see it on your bank record, you could still be hit with an overpayment. And myth number 3, SSA can't see my online bank. Absolutely false. Under Section 1631 E1B of the Social Security Act, SSA has full legal authority to verify your financial accounts electronically. They don't need your login. The AFI system provides full automated access to balances, account numbers, and deposit history directly from your bank. So, yes, they can see it, and yes, they already are. Here's the truth. An inheritance or settlement isn't free money when you're on SSI. It's a test. SSA wants to see if you'll report it, spend it correctly, and follow the rules. Do it right, and you keep your benefits. Ignore it, and you could lose everything. Your SSI, your Medicaid, and your financial peace of mind. So don't wait until it's too late. If you learned something new today, hit like and subscribe to Social Security Post. We break down every rule and change so you don't have to face these issues alone. And remember, if you have any question about inheritances, settlements, or SSA's new bank monitoring system, ask in the comments below. I'll personally go through them and answer each one to help you protect your income. Stay tuned for our next video, where we'll uncover how prepaid debit cards, Zelle transfers, and mobile banking apps are now being tracked under the same rule, and what that means for SSI recipients trying to stay compliant in 2025. You won't want to miss that one.